So we have arrived at the last stage of the accounting cycle. Statement of financial position. The journey started from basically what you call as the journals. Then we extracted ledgers from the journals, and then when we were talking about what you call as trial balance, it was a summary of ledgers more than anything else. And then finally we from the trial balance we first of all extracted the income statement, which we discussed in the previous two clips, and now we are starting statement of financial position, which is sometimes also called balance sheet. The old name is balance sheet, the new name is statement of financial position, because it depicts the the exact meaning of the statement which is being made. That is why recently the name has been changed to statement of financial position instead of balance sheet. Now when we are talking about this particular statement of financial position, which is obviously prepared at the end of the year, because the analysis part has to take place in the end. So the statement of financial position, when we were discussing the accounting cycle, I think we certainly discussed that thing, that it proves the accounting equation, and the accounting equation is assets are equal to liabilities plus capital, or assets minus liabilities is equal to capital. Fine. So assets minus liabilities is equal to capital is what we are going to prove over here. So that is what is happening in this particular clip here. Non-current assets, and then the current assets, and the current liabilities, and the non-current liabilities. Before we start getting into mechanics, let's very quickly talk about the two variations of assets and the two variations of liabilities. Non-current assets are the assets having a long life. Their life goes beyond their life goes beyond one particular year. Fine. So these are the assets like land and building, and motor vehicles, and furniture and fixtures. These are the assets which are going to stay with the business for more than 1 year. So that is why they are called non-current assets, because they have a longer life. Obviously, when it comes to current assets, these are the assets which have a life less than 1 year, which are easily convertible into cash, which are either cash or are easily convertible into cash. That is why they are called current assets. So two variations of assets: non-current, having a life of more than 1 year, they are not bought for resale; and current assets, they have a life of less than 1 year, and they are bought for resale. When it comes to closing inventory, especially, we are buying it for resale purposes. Okay, so what do? We add up all the non-current assets. We have land and building 10,000, motor vehicle 6,000, furniture and fixture we have 4,000, and we have 20,000 in total, which is the total of non-current assets. Then we have the current assets which are again being total 4, 3 and 2, 9,000 in total. Now, we have not added current assets to the non-current assets. Instead, we are following a different path, where we are subtracting current liabilities, which are the loans or liabilities payable within 1 year, from the current assets. So, current assets minus current liabilities, we arrive at working capital, which is, as I have written over here, current assets minus current liabilities. So, 9,000 was the total of current assets. 2,000 was the total of current liabilities. So 9,000 minus 2,000, we have calculated working capital. So 9,000 current assets, 2,000 current liabilities, we arrive at the working capital, which is 7,000. Now what is working capital? The word is literally self-explanatory more than anything else, but then again, it is the money required for day-to-day operations of the business. It has to be in positive, because if we don't have any money residing with us, we are not going to be able to spend anything or manage the operations of the business. So that is why current assets minus current liabilities is calculated, so that we are able to find out the working capital, which is the lifeblood of the business, without which the business cannot survive. So 7,000 is the working capital, and then we add the working capital to what? To the non-current assets, and we find net assets by doing that. Non-current assets plus working capital, we get net assets, that is the money available with the business, and then we subtract non-current liabilities which have to be paid out of the money available, and that is 2,000 in the current scenario. So 27,000 minus 2,000, the closing capital, the capital or the money or the finance that we end up with is 25,000. Now going back to the previous concept which we were discussing at the beginning of the clip, which was this particular statement of financial position, it proves the accounting equation, which is assets minus liabilities is equal to capital. Now we have all the assets, non-current and current, and we have subtracted the liabilities from the assets to arrive at the closing capital. So that is where the accounting equation is completely proved through the statement of financial position. The second part of the statement of financial position is going to be discussed in the next clip. Thank you very much.